Everyone is asking if the Bitcoin bottom is in, along with some of the altcoins and, of course, the market in general. And there's a lot coming in terms of not only news, but analyst positions. And we're going to take a look at all that for you guys today, break it down for you. I think you're going to like this one. My name is Paul Barron. Welcome back into Tech Path. Let's get into it today. I want to thank our sponsor, and that is CoinLedger. I know you're getting ready to do your crypto taxes. It's one of the most important things you can do every year, and that is making sure that you do the right thing around crypto and your taxes. CoinLedger is one of the best places out there to do it. So they do a ton for you in terms of automating the tool sets from all the different exchanges and places that you trade out there. So it makes it very easy to do. They have a ton of integrations out there, as you can kind of see on screen there. Absolutely just about every place. Make sure and check out our link below. It does help the channel out. So get out there and look at some CoinLedger. Let's get into it today. And I want to bring in Dr. Jeff Ross from Vailshire's Capital, who's been on with us a few times. And Dr. Jeff, of course, has had some different analysis here, and we're going to have a chance to break it all down. But thanks again for stopping in.
Thanks for having me, Paul. I'm happy to be here.
Yeah, absolutely. All right, so Jeff, let's get into a few things. I want to go right to your tweet. And this was really the thing that kind of jarred me for a minute. And I said, wait a minute, we got to get Jeff on. And it was this right here. I'm not going to lie. I'm loving Bitcoin's price action on the 4-hour. And then consolidation after a huge breakout move, and then from strength to strength, and talking about this highly bullish. This is right here what I was like, okay, wait a minute, something's up here. What is Jeff seeing in the market? Tell me what you're seeing in the market right now, Jeff, that's making you feel this way.
Well, so this is a huge paradigm shift for me, right? You've had me on, I think, several times in 2022. I've been very bearish, and in fact, they call me Dr. Bear on Twitter.
Absolutely.
And so it was literally all the way up until last week where I was still bearish. But then after doing some analysis, and I have a trading system that I don't try to time market bottoms, but I confirm bottoms. And so one by one, tons of indicators for me have started flipping bullish. And so that's something to take note of. And also these little bearish moves, buying puts or selling short stocks and things like that, suddenly is not working very well. And whenever that happens, especially if you're a fund manager, you have to take note of that and figure out, well, is this a regime change or is this just kind of a fluke? And are we going to go back to how we were? So all throughout 2022, the things that I look at were going in the bearish fashion. So global liquidity by central bankers and things like that, things that I watch closely, and what is the Fed doing? Liquidity was contracting throughout the world from basically Q4 of 2021 all the way through 2022. The dollar was strong, right? We've been talking about what are the treasury markets doing? Well, they've been inverted and severely inverted for quite some time now. The Fed has been tightening, right? They've been raising rates. And so what has changed now? Here's what's changed basically since 2022. Liquidity now looks like it has bottomed. In fact, global liquidity is actually slightly on the rise again if you factor in what China is doing. The dollar broke quite a while ago, a few months ago, in the fall basically, and has been basically breaking down, and it doesn't look like it's going to peak anytime soon or perk up anytime soon. It's just kind of flailing at 102 right now. VIX volatility has been kind of high and volatile, for lack of a better term, throughout most of 2022. Now it's just kind of sitting comfortably at around 19, and it also doesn't look like it wants to go up anytime soon. Whenever we saw these setups in 2022 with a low VIX, and we saw peaks in risk assets like stocks, like Bitcoin, like crypto, whatever, that was the time to put on a short and to bet against it. I would tell people to, what I'm doing is I'm shorting any rip that I see. But now when you have this regime change where now the dollar is weak, where volatility is low, where liquidity is actually now being added into the system on a net basis, this is the time to start leaning long. So this is the time where I'm starting to looking at buying the dips instead of shorting the rips.
Interesting. Okay. All right. We just showed the Dixie chart there on dollar, and you're right. The likelihood of seeing a recovery back to what we've seen over the past bit of time here, all the way back into December, it's really been on somewhat of a decline outside of that little bit of a pump right here in early January. So definitely right. Same thing with the VIX, to your point, really trending also into those cycles. So there are some signs out there pushing. I want to go back to this tweet right here. You had high yield, aka junk bonds, also risen over the 200-day moving average, first time since Q4 2021. Another bullish momentum shifts. Explain this one a little bit for me.
Right. So a few things are as risky or as considered risk assets as junk bonds, right? I think you could throw crypto in with that, things that are considered to be the most risky of the risk assets. High yield junk bonds have actually reclaimed the 200-day moving average, which lots of institutional investors use to signify, is this bullish or is this bearish? It's the first time it's been in bullish momentum since way back in Q4 of 2021. And you can go across the board. I did this. I have another tweet where I went through and basically just listed them. The S&P 500, the Dow Jones Industrial Average, small cap stocks, mid cap stocks, high yield junk bonds that we just talked about. Bitcoin just recently reclaimed it on Friday, the 200-day moving average. You can go overseas and look at things, emerging markets, Chinese stocks, European stocks, which surprises a lot of people because they're doing so terribly there, right? We're so concerned about where they are with their high energy costs and their recession and their consumer sentiment. Everything looks negative, but in spite of all that, they've regained their 200-day moving average. They're all showing bullish momentum. And when you see all of that happen across the board, I think ignoring that is just basically to your own peril.
Yeah, I think the scenario that has occurred here is the speed in which this has moved here in the last 30 days. We've seen a lot of scenarios that played out. Most likely, the question is how is this going to play out for Powell and how he'll address this with the upcoming FOMC meeting. What are your theories right now with the way the Chair Powell might be looking at the data coming in right now?
Yeah, absolutely. So first of all, I think they've got to be happy that they're seeing some solid and steady disinflation, right? We peaked, obviously, I think in June with a CPI above 9, and now we're in the 6s. That's good, and that's an encouraging sign. He said over and over again that he needs to see sustained lower inflation. He needs to see it moving towards the 2 to 3% range before he would do anything differently. I think that the bond market has already signaled that you know what, Powell, you've gone far enough. The 2-year Treasury yield, which generally historically has acted or served as a cap to the federal funds rate, has already peaked and has come down. It's currently, as we speak, is sitting at 4.19%. The federal funds rate is well above that right now. So what that tells me is if he continues to raise, the bond market is not going to like that. The bond market is signaling you've already gone far enough. And so maybe he raises another 25 bips. Maybe they go another 50 or 75 bips over the next couple of meetings. That's definitely possible. But I think what the markets are sensing right now is that the Fed is going to pause. And the Fed officials are already talking like this, right? They've gone from 75 bips per meeting down to 50. Now they're talking about 25. That's already basically baked in for the February 1st meeting. In the past, when we've seen the Fed pause after they've hiked rates up to a certain level and then they pause, that's when you see a rally and almost across the board. I think every time, at least for the first several months, you see a rally in risk assets. So I call this the Fed pause rally. I think it's real. Now, I want to caveat all of this by saying when the Fed is forced to pivot at some point, and by pivot, I mean start lowering rates rapidly, that almost always is during tough times. So that usually means that the floor is dropping out under risk assets. That means that we're in the throes of a recessionary bear market. It means they're actually nervous and that something is happening in the bond markets that are forcing them to jump back in and become active participants again. That still lies ahead of us. I just don't know when it was. To be honest, and when I've been on the show in the past, I thought it was going to happen in the first half of 2023. So I thought we'd be in it. But as the data keeps coming in, it continues to look like it's being pushed out further and further. So I don't know when it's going to happen, but I'm going to enjoy this risk on rally for the time being and then get ready to probably take profits and to use trailing stop losses because I think we have lower to go at some point, maybe the second half of 2023, maybe into 2024. I'm not quite sure on the timing.
Yeah, I was looking at in alignment with you and some of the things I started putting together all the research. I reviewed a lot of analyst video that we've talked to throughout the year, looked at some of their time estimates here. I did a tweet here this morning, and it was basically these things, considering if the bottom is in 2 quarters of declining GDP. That actually happened last year. So I stand back and I think, wait a minute. I mean, under normal rules, that would have been a recession. Could that have been the light touch that the market got, and we're starting to see the trickle effect? Fed pause on hikes have historically been positive to securities. That's back to your point. Inflation is obviously falling fast, whether or not we continue to see that moving. Jobs are holding. even though I still am a little on the fence about whether or not jobs can hold. The only warning flag, if there is one, is I'm still worried about credit piling in on us, here that could cause. But I don't know that that is going to be a monster issue if we don't see monster issues in the markets themselves. In other words, we don't see some price stability, because that's still the number one thing for Chair Powell is get to price stability. Are we seeing enough decline in markets? Then I go back over here to Alf. This is Macro Alf from Macro Compass. Says bond market price, la la land. Inflation back to 2.5. He's claiming 9 to 12 months. What are your thoughts about potentially getting back into that target zone for Chair Powell?
I think it's possible. Right now, the only thing holding the CPI up, as most people know, is the owner equivalent rent, right? So basically, what did housing do? And that runs on about a 15-month lag. And so the reason why the CPI is still as high as it is because the housing market was so hot about a year ago. And so as that peak from about a year ago hits it and then starts to descend again, we should see CPI fall alongside with it. And there's basically nothing else holding up the CPI as far as I can see. And I don't really see other things coming in to surprise to the upside going forward, especially if we have any kind of deflationary bust type event across any risk assets. Now, I will say a couple things is that I agree with the points that you made, and I think that it's possible we have basically an easy recession similar to what we had in 2000 to 2003-ish time period, and then as well as the early 1980s. What that means to me is this all kind of goes along with the grand thesis. I think value outperforms growth in tech stocks basically going forward, similar to after the dot-com bust. I think the NASDAQ is going to struggle for the next several years. So even though we'll see some nice ramps higher, I would not expect it to last. We're not going to get another redo of the last decade. I think that value will just tend to do pretty well, even in the face of a soft recession. Things that are more kind of recession proof, that companies that have pricing power, think like Starbucks, maybe Amazon, maybe Netflix. Those kind of Netflix even is kind of turning into like a blue chip stock. People just want it for entertainment. So those kind of companies that have pricing power could hold up pretty well this decade. I think the high flying tech growth, I think actually even some crypto, because they're kind of the high flying, right? That's where people use leverage and things a lot. Some of those may kind of struggle, I think, going forward versus like the blue chip Bitcoin, just the sound money kind of principle may do kind of well. Gold may actually do pretty well as well going forward. So we'll see. Time will tell.
A couple of things to still, because we are always cautious. Me, I'm more of a conservative investor. I look at things, and we were picking more toward mid-year, and with some of the things that are starting to implement at least early on. Now, granted, this may be a full-on bear trap. We could see a bit of a, kind of a bear market rally here and some adjustments here. But if you look at stock market, this is one of the legends out there that kind of talks about the potential around U.S. labor forces still being a problem. And Peter's talking about this in the sense of, yes, labor is still going to be a challenge here. At the same time, we've seen now double job reports that are continuing to show stability. And I've continued to talk with CEOs in the restaurant industry, which is where the big sector is of growth in hospitality and entertainment. And they're telling me that right now they're not slowing down hiring. So that tells me something, that there's still demand for their business, and they're willing to continue to invest in their caps. So with that being, the case, where could we see, some of these risk assets run to? Let's just take Bitcoin as to where it is right now, trading at 21K.
Sure. I mean, I don't use price targets. I just use momentum, right? So I think that as long as it's bullish, it's going to continue to go higher. How high? I don't know. It depends when things change again. But for now, I'm bullish and I remain bullish. And so I would be surprised if it got back up to its all-time highs by the end of this year. But I wouldn't be surprised to see it get into the $40,000-$50,000 range by the end of the year. We don't know. I do want to touch on that point that you just brought up about the services sector. The services sector, I think, never really recovered from COVID. They've still been trying to grind it out. They got lots of them got forced to shut down. They've been short on employees and staff for years and years, and they're just still trying to dig out of that hole. A lot of people are focused on the manufacturing metrics, which are clearly in a contraction, but that's only a very small part of the U.S. economy. So you got to look at what the services industry is doing. I think, and this gets back to kind of what I was saying a little bit earlier, Where we're seeing the massive layoffs is basically in the huge tech companies. They're the ones that are getting hit. They're the ones that I think are going to really struggle through this next wave. They're the ones that benefited massively from what happened at COVID, right? The whole
Exactly.
everybody forced to stay at home. And it's the services industry that I think is going to grind it out and do better and continue to grow, while the tech sector is going to continue to struggle for the foreseeable future.
It's interesting you say that because I go over here to my just my stocks that I that I have in food because I own some food stocks, and this is Chipotle, climbing back up in here to almost $1,500 stock, down from what was around 1350. That's a big move, and I watch the food sector because it has a lot of indicators around price stability, and also because of the jobs implications. Because if those stocks are healthy, you look at McDonald's, the typical stocks that do apply to where a lot of workforce is being added to the marketplace. And those are the data points that I'm watching very closely, because once those slow, then it usually has that effect into the jobs market, and that's when we see those kind of adjustments. All of that being the same, and you got Peter Schiff here. Let me kind of go. Actually, I want to go to Gareth. Gareth he is on the contrarian view. Gareth is, of course, coming in right here. Hey, listen, 25 years of trading bull bear. He's basically saying, believe a new bull is here. Don't get FOMO'd in. This run is insane. And then he's also taking a look at others. But he's saying Bitcoin hasn't taken FTX collapse high out of the market just yet. So I think he's still leaning a little bit more caution right now in terms of trading.
Yeah, if I can jump into that, I've been coming out pretty bullish in my tweets, and tons of people are coming at me, and they're actually pretty upset with me and saying, this is just another bull trap. And I say, you know what? If this were 2022, I would agree with you, and I would be putting on shorts right now. But I'm telling you, there's been a regime change right now. As long as the dollar is weak, as long as volatility is low, as long as liquidity is being added to the system instead of contracting actively, you have to lean bullish, I think. And I think this guy, no disrespect to him, but I think he's being fooled by last year's game plan. I think we're onto a new year and a new game plan.
New game plan, yeah. You got Peter Schiff in here doing the Peter Schiff thing, which is always the contrarian position. His is right now, hey, inflation is still kicking our tail and it's going to win the war. Again, we're starting to see the softness of inflation. This goes back to price stability for Chair Powell, because that is his number one. Let's just play this out for a second. Inflation starts to soften right here coming in February. We see another nice down print. Maybe we go into another down print in March. At that point, do you think by then, because now you have four down prints in a row, do you think at that point we've pretty much said, okay, trend is here, we're going to continue to see a downward movement on inflation?
Well, like I said, I think the bond market already thinks that they're done raising rates because the 2-year it's peaked and it's been coming down for quite some time now. It's sitting at 4.188% right now. It doesn't think the Fed is going to raise much more in it. And so the markets are sniffing out this Fed pause. And that's why risk assets are rallying right now. And I believe it. Until there's a reason to disbelieve it, I'm going to continue to go with it and believe that the Fed won't be raising much more than they have already. Maybe they get to 5 or 5.25, but they won't keep it there for long, I don't think.
Right. Well, that'll be the big question is when we start to see a reversal, because that right there would indicate a very significant move in terms of the S&P, what people would look like in terms of securities and kind of their forward-looking statements. Again, we'll still see some of the tech companies Q4 earnings and then the Q1 earnings start to address, I think, and those would be some challenging positions. Dylan Clara was talking about bringing inflation back under control means you have to damage the real economy. Do you feel like we've got enough damage here? This is BlackRock's vice chair talking about that maybe there's still some more damage left in the market. What are your thoughts?
I think that they're going to continue to damage the economy. And I think that because of the delayed effects of high interest rates, that we still have to watch all of that play out across real estate. It's a high cost of capital for organizations. We're going to see continued damage going forward. Now, if I were them, I would pause right now and be like, I think we've gone far enough. The bond market is signaling that. We're seeing inflation come down significantly. We admit to the public that the only thing holding up the CPI currently is the owner's equivalent rent statistic, which is sort of funny. I think if they could come to that acknowledgement that they wouldn't have to do much more. And I think if they continue to raise rates and hold them higher for longer, they're going to do serious damage. And I just don't think they need to put the economy into a severe recession. And they
Mhm.
will do that if they continue to go higher and hold them higher for longer. But if they just kind of chill out and watch it, I think they could actually get away with a soft landing and a mild recession. I don't think unemployment would go that much higher. I think tech would take the brunt of it, as it should, because it got way overvalued as of
Right.
fourth quarter of 2021. So let some of that stuff get worked out. Let's do some reversion to the mean type investing going forward. Let's let value run for a while. And I think the Fed could get out of this without causing too much damage. I'm not convinced that that's what they're going to do, though. I think we'll have to wait and see.
Yeah, well, I mean, think about this too. We are past our midterms. We're starting to move into a cycle for the next presidency. There could be some political ploys that start to make its way into this, especially for this year, if we continue to see inflation start to get under control here. Bitcoin's 4-year cycle, this is kind of just showing a little bit more on what this article is claiming, which is on-chain and technical data beginning to suggest that the bottom could be there. I'm definitely not calling it yet. I still feel like we got some pain, but there is an opportunity here, I think, of these runs. But a closer look at Bitcoin's long-term price action revealed that the run-up to the top and bottom of previous cycles look remarkably similar to what we're dealing with right now. I know you don't look at those historical aspects, but when you hear people that do, because a lot of analysts and traders, they look at these historical charts like the Bible. And now we're starting to see some alignment there that is potentially kind of moving to that. What would you kind of say to that point?
It's ironic you showed that chart because I found that same one and I actually retweeted it because it's so uncanny. It literally comes
Yeah,
down to the day of where it peaked and then it descended and hit a bottom,
exactly.
literally to
Yeah,
the day of the previous two cycles. And so, and did it happen again? It might have. I just think Bitcoin is such an incredible invention. I mean, it's really amazing, and it's so mathematical and logical. And could it possibly be that it's just on this true 4-year cycle that not, and it's not a 4-year cycle, right? It's based on the halving cycle, which isn't quite 4 years. It's a little less than 4 years, but it seems to keep following this same pattern. And is it just coincidence that it's in the same pattern? It's happening at the same time as global liquidity expansion and contraction as well, and with business cycles as well, expanding and contracting, where we go into these high points and then down deep into these recessionary periods. It's just uncanny, and I don't really have another term to describe it, but I don't know if that's just a coincidence and just a fluke, or if it's just really how Bitcoin is because it's just programmed. Maybe that was the bottom. Maybe that chart calls it perfectly again to the day, basically,
yeah,
and now we're just on a ramp higher. I will tell you that 4 weeks ago, I made a bet with somebody on a Twitter space that I said Bitcoin hadn't bottomed yet. I still think it's going to go lower before the Bitcoin conference in May, and he said it had. I think he's going to be right again. I think the stuff I'm looking
interesting.
at, even though I think we have a recessionary bear market still ahead of us somewhere, I don't know that it will pull Bitcoin down quite as far as it has. I think the reason Bitcoin came down as far and fast as it did had a lot to do with all the crypto contagion, across SPF, Terra Luna, Voyager, Celsius, all those kind of things. That really pulled it down hard and fast, I think further than it needed to go. And so now it might just be kind of a slow grind higher from here on out.
Yeah. Yeah, our look at it, over the last quarter of last year, we were still looking at the high 14s as being kind of the potential for where that target was, even though we had a lot of analysts on that were pointing at, 10K, 12K. There were some things that kind of pointed in that direction just because of the severity of what was happening with the Fed at that time. We had not seen the CPI numbers. We had not started to see the job numbers kind of readjust in the latter part of last year, now moving into that. With the halvening playing into this, again, timing, very interesting, almost uncanny to your point. Halvening plays into this. We're talking early 2024. Timing wise, CPI gets under, or inflation gets under control. Fed potentially reverses interest rates, let's say in Q1, this time next year. What does that do for Bitcoin? Because that to me would just be an absolute barn burner.
Right. I agree with you. I think it's off to the races at that point. I definitely think Bitcoin ends 2023 much higher in price than it is currently, but I also think
Mhm.
2024 will be a much better year than 2023. And
Interesting.
then continuing on with that sort of 4-year pattern that it's had, and then usually in that fourth year, so 2025, will be just kind of a rip roaring year. I think risk assets, and again, it's uncanny how it times up with the macro economy, with what other risk assets are doing as well. It seems like everything kind of rips in tandem. But Bitcoin is the great absorber of global liquidity. And so as liquidity, if we do have QE next, QE infinity, and it's massive like lots of us anticipate, I think Bitcoin is going to absorb a lot of that. A lot of dollars, a lot of institutional dollars are finally going to come into Bitcoin because they're finally set up and ready for it. And that could push it to amazing. I think 6 digits to me is a no-brainer. It's just a matter of how high into the 6 digits it gets.
Yeah, this is something I'll leave on this, and this is our own power index sentiment chart. And for some of you that maybe have never seen this, what I will tell you is we have not seen a 60-point sentiment on Bitcoin on the high side, and now nearing on our amplification, which is kind of intent, and we look at a couple of things. What's the buzz around it? It's kind of the network effect. That's the purple line. And then the red line is looking where people are really talking about very specific things. I'm getting ready to buy Bitcoin. I'm adding to my bag. Those kind of elements that we pull into the natural language processing algorithm that we've built around this. We haven't seen this level really since back pre-run-up to its all-time high. So it has made a major adjustment in a span of about 3 weeks so far. So it's very interesting. And when we look at this over time, back several years, these are typical signs that start to look in this direction. So again, I think it points to you. I'm still very cautious as always, but that's just being a business guy. You're always prepared for the unexpected.
Yep, absolutely. You have to
anyway, Jeff, this is always fun. I want to jump over to our poll real quick and see what the audience had to say about this one. All right, so Bitcoin bottom. Ooh, very close too. Interesting. 52% though, at least on the upside around this. But again, I think this also kind of. I hate to sometimes project into my audience because sometimes I feel like they're more cautious just because I'm cautious.
Right.
You guys go out there, do your research. You're going to find things just like Jeff and I do, and it starts to make your day a little bit more convincing when you're doing your investing strategy. So, Jeff, always fun to have you on the show. Thank you so much for stopping in today. We appreciate it.
Thanks for having me, Paul. Anytime. I love being on your show.
You bet. All right, so you guys are tuned in over on the podcast side of things. You just missed some charts here. Some breakdowns on where Bitcoin's movement could be. More importantly here, when I look at just overall the markets in general, I'm actually leaning into a bullish sign. And these are only because of the things that we talked about here in the show. What I'm hearing from a lot of CEOs in the market around jobs, that concerns me because I'm not quite as concerned about that. I'm still concerned about credit. Don't get me wrong. That's just the pragmatic approach. But you guys can catch all of our stuff here on the YouTube channel where we dive in deep to a lot of these kind of things. But best of all, you can jump right into the Diamond Circle. It's our free newsletter. It goes out a couple times a week. We recap you on stuff like Bitcoin, what's happening in the altcoin market, and of course, Metaverse and Web3. And of course, if you want to reach me, it's out there on Twitter @Paul Barron. We'll catch you next time right here on TechPath.